Hello and welcome to your Global Markets Technical Outlook and the market wrap-up for the end of Q1 2023. Normal disclaimers apply, of course, and if you want the too long didn't read summary, well, it's a bit of a mixed bag out there, folks. So let's dig into it. First of all, kicking off as we always do with the US stock market. And on the monthly chart, you can see there is the last few months have really just been quite sideways in the market as we see price consolidate around that psychologically important level of 4,000. Bounced, went up back into it, but hasn't managed to make any headway in the last 3 or 4 months. On the weekly chart, however, we do see signs that it has just sort of moved out of this channel. It's not particularly convincing. You might want to call it something like a nascent breakout. It's, I certainly wouldn't be convinced until we get above that 4,200 high there, but we're out of the channel. Perhaps we're moving into a bit more of a sideways grind now, or perhaps we make another smaller move up. On the Ichimoku chart, we can see that cloud resistance coincidentally is also at that sort of 4,200 level, down to about 39 at the moment. And you can see that price, as we would expect, came up, tested the area, came back down, and has now retested there and is kind of just dribbled out the bottom of the cloud once again. So we'll see if it can muster up enough energy to try and have another go and get above that 4,200 level and break through. But for now, it's looking like it's just running into a little bit of supply around that area. Heading into the fundamentals now, and the bullish percent index telling us that it's a 50-50 market. So there's about 50% of stocks that are bullish, about 50% of stocks that are bearish. And you can see that's giving us this quite sort of sideways looking pattern that we're seeing in the price of the S&P500 index itself at the moment. On the NYSE stocks above their 200-day moving average, it's also in that very middle of the road area, 57% on there. Although this has been moving up, so that perhaps just give us a little bit cause for hope. Again, market responding just very sideways at the moment. The discretionary versus staples is still printing lower highs and lower lows, so we're not seeing any divergence there at the moment, just sort of tracking the market lower since when it turned down back at the start of last year. So we'd really probably want to see this ratio peak up above that sort of 2.3 area to have some sign that we're starting to see the discretionaries outpace the staples, and that would give us some hope that the market might respond to the upside. However, on the semiconductors versus the index, we can see that ratio has now popped. It's broken out of this sort of downtrend area that we had up until the end of last year, and it's now popped up and made a new high above these last two peaks here. So that's very encouraging, and these are the kind of leading indicators that we really need to look for to have any hope, if you like, that the market might respond. Now, this is only one of many indicators, and we need to see a lot more across the board. But maybe this is perhaps just one green shoot that's worth taking note of in the meantime. The advanced decline line has also broken out of its corrective downtrend that it was in. Market not responding yet, but again, once again, if we see that continue to move up, there's another green shoot, and that might pull others, such as the discretionaries versus the staples, up with it, and then henceforth the market will respond. But still early days, and as I said at the start, this is a very mixed bag. We're seeing conflicting signals both to the upside and the downside at the moment. Speaking of which, here's the Baltic Dry Index, which is basically the cost of shipping around the world, and you can see that it's very much in that lower high, lower lows. The global economy has obviously been slowing down, and this is one result of that we're seeing here. But this also plays into market activity as well, and that's having a depressing effect on the price of the S&P 500 more broadly. However, if we look at the relative performance of the three big indexes, we can see that the Nasdaq has been leading year to date. And if you recall from last year, that was the opposite to what we're seeing now. The Nasdaq was actually in the toilet more or less, but now the Nasdaq actually leading, and that's an encouraging sign, because the Nasdaq contains the more speculative stocks in the market. And if people are willing to take a punt on those, that will tend to bring up the broader market eventually. The small caps in the middle somewhere, and the S&P bringing up the rear down there about 4% year to date. And here might be one reason why we're seeing the US basically pausing their rate rises for now. That's causing the bond yield to fall. This purple line here is the US 10-year Treasury, but the line is inverted. So when it's going up here, that means the rates of the bonds are falling. And the Nasdaq stocks are very rate sensitive. They're what they call duration plays, which means that their profit potential is very sensitive to changes in interest rate. So if we have interest rates falling, relatively speaking, then we have the Nasdaq responding to the upside. So that again is perhaps one reason why we're seeing that signal there between the Nasdaq and the S&P 500. And this will, we will have to see where this goes depending what the Fed does next. But for now, this could be, again, one early sign that things are starting to look a little bit more positive in the near term. However, lots of howevers today, but flipping the coin the other way, and we can see that the yield curve is still in this big inversion here. So the 10-year, this is the 10-year line here. You can see it's just been falling a little bit, which is what we were observing on that last chart. But while it's falling, the other end of the bottom end of the curve is actually rising, and that's leading to this worse and worse inversion. These shadow lines show where the yield curve has been. So you can see it's tipping ever more steeply down from the top left to the bottom right of this chart. And why is that important? Well, if we look historically, we can see that every time, well, not every time, but almost every time we've had an inversion in the past, it's led to a recession in the next 12 to 18 months following that. So this is where we are here. You can see way up here, and you can see that these gray lines here are the previous recessions, and you can see that recessions have been triggered from much shallower inversions than the type of inversion that we're now seeing. So what does that mean in practical terms? Well, the New York Fed put it at a 57% probability of a recession in the winter of 2023. That's obviously the northern winter of 2023, the end of this year. But once again, you can see that recessions have come and gone when the probability has been much lower than that. So make of that what you will, but it does seem like perhaps there's at least slightly better than a coin toss chance that we'll be getting a US recession, and by extrapolation, that usually means globally. On the sentiment indicator, we can see we're more or less just in the middle of the range here. Nothing really to write home about. We've sort of come out of this bearish extreme as the market sort of crawled its way back up and now consolidating. So very much just in the middle of the range, and not any extreme to report this time around. Also on the VIX, we see that volatility has calmed right down, not right down to previously historic low levels, but at least it's back down into what I'm calling the low risk band here, between kind of the low 20s and the sort of the low teens, if you like. And so this tells us that there's not much happening in the market. There's not a lot of hedging going on against downside risk, at least in the near term. So again, perhaps the players starting to favor either sideways or the upside just a little bit more than they have been. So there's a quick gaze into the crystal ball from here. And one reason why this market is showing this kind of schizophrenic, two-faced side to it is that we have this tension between whether there's going to be a recession or not. As we've seen, it's probably about 50-50 at the moment. Now, in 2018, everybody expected a recession. The market dumped initially, but then there was no recession and the market took off. So we have this green line here for 2018. In 2008, of course, the recession was almost unexpected, really. Well, it was expected, but no one sort of realized how bad it was going to be. And of course, we know the end result. If you've been around a couple of years, you'll remember that. Of course, what we've got now with this white line is where we are now. And the question is, if we have a recession, then perhaps we sort of start to follow the 2008 path. But if we manage to squeak by without a recession, then what if this line starts catching up with 2018? So we're kind of in this sort of sideways balancing act at the moment, just waiting to decide or to see what the economic outcomes are, and that will sort of give investors their cue about whether to take risk on or to take risk off. And if we look at the seasonality chart, the year to date down the bottom here, it's not really clear what, it's not clear from this chart whether it's a good match or not. The first couple of months of the seasonality tend to be sideways. I guess you could argue it has been quite sideways, maybe a little bit up from where it started. What's interesting is that the next 2 or 3 months look like they might be reasonably bullish if we follow this seasonality path. So that's something positive that the market can anchor itself upon. On the presidential cycle, we're in what's called the pre-election year. There'll be the presidential election next year in 2024. And this is the average. This blue line is the average of all the pre-election years. The orange line here is the annual seasonality, and the little chart down the bottom here is showing year to date. The obviously it's showing quite a bullish picture in the cycle. We've had a little bit of what you might call sideways start to this year. But once again, following on from that last slide, as we can see here that through the next 3, 4, 5, 6 months, according to this cycle at least, we are kind of more in a bullish phase, and hopefully once again that's going to act positively on the market if we can manage to avoid those recessionary outcomes. And on Calvert-Clark's 2023 pressure chart, you can see we're also seeing that months 3, 4, and 5, March, April, May, are 3 of the strongest months on average that we should expect. So again, another positive sign perhaps for the forthcoming quarter. On the 10-year cycle, you can see that where we are in this year 3 is starting to look a little bit more bullish than where we have been in year 0, 1, or 2. So just perhaps the start signs of maybe something bullish. And again, this might feed into bullish play in the market, assuming that we don't get a recession or a bear market in the meantime. Calvert's pressure chart for the decade also showing that year 3 is about probably the 3rd strongest on average, and so again perhaps that gives us a little bit of hope that the 2023 won't be a complete disaster, but you never can tell, of course. Switching to the Aussie stock market now, and you can see it's been very much sideways for the ASX 200, stuck between this old 2007 high of 6850 and then up here at this 7600 there, just tracking sideways, although higher highs coming into it. So if it can get a head of steam up, then if it can make another attempt through that 7600 level, we probably should favour the upside. On the weekly chart, you can see how it's had 1, 2, 3, possibly 4 attempts at that 7600 level, and now just coming back a little bit in the middle of the range between those two key levels I just mentioned. Once again, we should probably favour the upside just slightly, but for now it's just sideways on the 200. However, on the Ichimoku chart, you can see that the price has now moved through the cloud, came back, tested the top side of the cloud, found some side support, and it's now up and away, giving a little bit of distance from the support itself, which now rests at that 6,800 to 7,000 levels. So once again, if we did see the market come back to that key support level, then we should expect that we might find some demand showing up at those levels. Looking at our nearest neighbours and across the other side of the Pacific, we can see that the ASX 200 just a laggard, but around about where this S&P 500 and the Hang Seng are sitting up about 4% and a bit for year to date. The Nikkei and the Shanghai doing relatively much better, up around 6 or 8% for the year. On the currencies now, and well, it's US dollar strength is the big story, I guess. It hit that 114 level. It's come back, just retesting that 104 level there. It's just pushed, it probably just came down through there just to wipe out all the long stops, who knows, but it's now pushed back up there. We've got a nice sort of overlapping bullish candle there, and if it can hold above that 104 level for a couple of months or so, then I think we should start to favour the upside more than the downside at that point for the US dollar. As you might imagine, US dollar strength spells weakness elsewhere, so most of the other charts we're seeing going down at the moment. Aussie dollar had another crack at that 70-cent level, but beaten back, and it's now back in the mid-60s again. 60 would be the absolute floor where we would probably expect to see demand showing up, but lower highs and lower lows at the moment for the Aussie dollar. On the euro, it has recovered from that blast down below parity. Obviously put the wind up a few people there. It's now back above that 105 and just trying to find some support there, back in that 105 to 120 range for now for the euro. British pound, a very similar looking pattern. It's just sort of flouting with that $1.20 area there, as you can see. And for now, it seems safe from parity, but you know, we shouldn't discount another test of it should it get down there again. The yen not looking all that great, and you can see how it's sort of ever since that sort of 2012 high way back here, it's been pretty much lower high, lower lows with a big sort of area of consolidation in the middle. It's currently below its last, it's now resistance level at 0.008 cents, and it's now down at 0.007 cents. So not looking rosy for the yen at the moment. And on the Bitcoin, well, you can see it's sort of languishing at this 19,000 to 20,000 area at the moment, obviously well off its 65,000 highs. So either crypto is dead or we should be buying when there's blood in the streets. I'll leave you to decide on that. Switching over to the commodities now, and on the crude, we see oil has been coming off. Just had a quick flirt with that 120 level there, broke briefly through that old resistance area at 112, but it's now well and truly back in there. I've seen sort of quite an impulsive move down, just trying to find a little bit support at this 76 level, but with the strength of the selling behind that move, probably shouldn't be too surprised if we see a pop below 76 for oil. Wheat also coming off, wheat now flowing once again from the Ukrainian ports, so that's a positive sign for food exports, and that's driving the price a little bit lower for now. On the gold, well, hands up Darvis box fans, because this is right in your wheelhouse here. We're seeing the price just stuck in this range between 2080 and 1620. Obviously, it's going to be a big move when it actually does move, but you know, it's been stuck here for 2 or 3 years. We'll have to wait and see how much longer it can last. That key level at 1925 hasn't really been meaningfully breached. Each time it's made an excursion above that, it's been pushed back. So I don't know, it's sideways very much for gold. Copper also looking reasonably sideways at the moment. Pretty sort of good inverse looking chart of the US dollar here, as we can see. Obviously copper priced in US dollars, but that 465 was obviously the key level for copper. It's now been pushed back. Did find support just in the low threes there, and it's back in the middle of the range again. And on iron ore, well, found support at that $80 level. That's obviously key support now. And this 126 level, which has been a key area of both support and resistance going way back, is now being flirted with once again. You can see the momentum just drying up in that uptrend there. So whether we see it roll over at this area or whether it can have one more push, obviously a strong US dollar prevents too much headway, all other things being equal. So just to summarize that, on the US stock market, very much sideways, and as you can guess from the number of times I've said however, there's very much a series of conflicting signals, some pushing the bullish case, others pushing the bearish case, and that yield curve really kind of just looming over the market like a big shadow at the moment. So we'll have to wait and see what happens here. It could really go either way at the moment. The Aussie 200 holding close to its highs. That 7600 level remains the key level for the Aussie 200 to get up and over. And on the currencies, we're seeing US dollar strength, which spells weakness for the other majors, of course. And on the commodities, oil and wheat just coming off their highs at the moment, and most of the others just seem to be consolidating at the moment. Just before I wrap up, a few people have asked me about the sort of strategies that I trade. Here's a couple of them. One's called Sapphire. It's a ASX strategy, trades ASX stocks on a rotational basis, basically a momentum trading system. And this other one here is called Dolphin. It's a US index ETF, mean revert system. It has a very, very high win rate. I like both of these. If you're interested in seeing what I trade, jump onto smartsystematictrading.com, and you'll be able to see 2 or 3 of the types of things that I've got there. I'll let you go, and thank you very much for your interest. If you want to get on the mailing list for this video, comes out once a quarter, please drop me a line at helixtrader.com. You can find me easily on the internet, but I'm on Twitter at helixtrader. And with that, I will wish you good luck, good trading, good luck for the next quarter, and bye for now.